The market feels uncertain right now, right? Inflation, layoffs, housing slowdown, and global tensions, everything is starting to feel like the calm before the storm. If you've been watching your portfolio move up and down and you're asking yourself, are we heading into a recession, then you're not alone. But here's the truth, recessions aren't the end of the world, they're the ultimate test of discipline and smart strategy. So in this video, let's talk about how to prepare your investments for a recession, what you should do right now to not just survive, but actually position yourself to thrive when the economy recovers. I'm your host from Stock Predictor, and if you care about your money, your future, and your financial independence, stay tuned, because this one might just save you thousands of dollars. Let's start with the first reality, recessions are a normal part of the economic cycle. They're not rare events, they're inevitable. Historically, the US goes through a recession about every 7 to 10 years. The last major one was in 2020 due to the pandemic, and before that, 2008's financial crash. Each time, markets fell, fear took over, and people sold out, but every time after that, the economy recovered stronger. The people who stayed calm and prepared properly ended up multiplying their wealth. That's the key lesson here. The worst times often create the best opportunities, if you're ready. So what should you actually do? Step 1. Build cash reserves. This is your safety net. Most financial experts recommend having at least 3 to 6 months of living expenses in cash or a high-yield savings account. But in uncertain times like now, I'd personally aim for closer to 6 to 12 months. Why? Because if you lose your job or your investments take a hit, you don't want to be forced to sell assets at a loss. Cash gives you flexibility, and it's not just about safety, it's about opportunity. When stocks drop, cash lets you buy quality companies on sale. Step 2. Review your risk exposure. Look at your portfolio and ask yourself, if the market dropped 30% tomorrow, could I emotionally and financially handle it? If the answer is no, it's time to rebalance. During good times, risk tends to creep up. You buy more growth stocks, you chase returns, you get overconfident. But during a recession, that overexposure can crush you. So consider trimming positions that are highly speculative or overvalued. Move that money into stable sectors. Utilities, consumer staples, healthcare, and dividend-paying stocks tend to perform better in downturns. These companies sell things people need no matter what the economy looks like: electricity, food, medicine, and household goods. Step 3. Don't try to time the market. It's tempting to think you can sell everything before a crash and buy back at the bottom, but that's a losing game. Even professional investors fail at timing consistently. Missing just a few of the best recovery days can destroy your long-term returns. Instead, focus on time in the market, not timing the market. Keep investing regularly, through dollar-cost averaging. That means buying the same dollar amount of investments each month. When prices drop, you automatically buy more shares. When prices rise, you buy fewer. Over time, this smooths out volatility and builds wealth steadily. Step 4. Protect yourself with diversification. Don't put all your eggs in one basket. Make sure your investments are spread across different asset classes: stocks, bonds, real estate, maybe even some exposure to commodities or gold. Each of these reacts differently during a recession. For example, when stocks fall, bonds often hold steady or rise as investors move to safety. Gold can also act as a hedge against fear and currency devaluation. The goal is not to avoid losses entirely, that's impossible, but to reduce the impact of any single market drop on your overall wealth. Step 5. Pay attention to debt. High-interest debt, like credit cards or personal loans, can destroy your financial flexibility during a recession. The interest eats away at your cash flow and makes it harder to invest when opportunities arise. So before things get worse, start paying down that bad debt. Refinancing into lower rates or consolidating loans can also make sense, especially if interest rates start falling during a slowdown. On the other hand, if you have low interest debt, like a fixed-rate mortgage, that's not a big concern. Focus on liquidity and stability first. Step 6. Don't panic sell. When fear spikes, many investors make the same mistake. They sell everything and move to cash, thinking they're being safe. But historically, the biggest gains happen right after the worst declines. Think back to 2009, when the S&P 500 was down nearly 50%. Everyone was scared, headlines were screaming disaster, but the next decade turned out to be one of the strongest bull markets in history. The people who sold missed out. The ones who stayed disciplined built massive wealth. Remember this: fear is temporary, but regret can last a lifetime. Step 7. Look for bargains in high-quality companies. Recessions create fire sales. Stocks of great businesses drop along with bad ones, simply because the market moves in fear. This is when you can find incredible opportunities, companies with strong balance sheets, consistent cash flow, and a competitive advantage. Think of names like Apple, Microsoft, or Johnson & Johnson. If their prices drop 20 or 30%, you're getting long-term winners at a discount. Always ask yourself, if this company didn't exist, would the world miss it? If the answer is yes, it's probably a keeper. Step 8. Consider defensive ETFs or index funds. If picking individual stocks feels too risky, invest in broad market ETFs like the S&P 500 or sector-focused funds that hold defensive industries. Index funds are automatically diversified and have low costs. You get exposure to hundreds of companies, reducing your overall risk. Over time, even through recessions, index investing has proven to outperform most actively managed funds. It's simple, stress-free, and powerful for long-term wealth building. Step 9. Invest in yourself. During a recession, job markets tighten, and opportunities can shrink. But this is the perfect time to upskill, learn new tools, or even explore side income streams. Whether it's learning coding, marketing, or investing strategies, knowledge pays the best interest. The more valuable you are professionally, the more secure your income becomes. A strong personal skill set is recession-proof wealth. Step 10. Stay patient and think long-term. Markets move in cycles. After every crash, recovery follows. After every downturn, innovation and growth return. The people who get rich in markets are not the ones who panic at every headline, they're the ones who think in decades, not months. So keep your focus on your long-term goals: retirement, financial independence, generational wealth. Don't let short-term volatility distract you from that vision. Now let's talk about one thing most investors forget: mental discipline. Investing during a recession is as much about psychology as it is about strategy. When your portfolio drops, it hurts. You feel like you're losing control. But remember, you haven't lost anything until you sell. The stock market is a weighing machine over the long term. If you believe in what you own and it's fundamentally strong, downturns are just noise. Separate emotion from logic. Stay grounded in facts, not fear. Another powerful move during a recession is tax loss harvesting. If you have investments that are down, selling them can create a tax deduction that offsets your gains. You can even reinvest that money in similar assets to maintain your strategy while benefiting from the tax break. It's a smart way to turn temporary losses into long-term savings. Also, don't forget about real estate. While housing markets often cool during a recession, that can mean opportunity for investors with cash or strong credit. Sellers become more flexible, mortgage rates might fall, and you can find great deals on rental properties. Just make sure you're buying for cash flow, not speculation. The numbers must work even if prices take longer to rise again. Lastly, stay informed but avoid panic news. Media thrives on fear, it sells clicks and views. You'll see constant headlines predicting crashes and doom. But smart investors know the difference between noise and signal. Follow trusted financial sources, understand the data, but always make decisions based on your plan, not emotion. Here's the bottom line: recessions are tough, but they're also where real wealth is built. The people who prepare ahead, stay disciplined, and keep investing intelligently are the ones who come out stronger on the other side. Don't wait for the panic to start. Start adjusting now. Build your cash cushion, rebalance your portfolio, control your debt, and focus on long-term growth. And if you found value in this video, hit that like button, subscribe to Stock Predictor, and share this with someone who might need to hear it right now. Because financial preparedness isn't just about money, it's about peace of mind. Recessions don't last forever, but smart moves made today can pay off for the rest of your life. Stay smart, stay calm, and I'll see you in the next video.